From New York City for our viewers worldwide, I'm Scarlett Fu. Bloomberg Real Yield starts right now. Coming up, the 10-year Treasury yield hitting its highest level since last summer as the Iran war is set to enter its fifth week. New data out this morning points to U.S. consumer sentiment sliding. Gasoline prices also pushing up inflation expectations. And private credit fears putting redemption requests in the spotlight. Today, Oaktree joins the list of firms needing to address withdrawal requests. We begin with the big issue, the Iran war uncertainty weighing on economic forecasts.
There's so much noise in the world. It's very difficult to be definitive around this.
The truth is we can't predict how much longer the conflict will last or how much worse it could get.
This is a supply shock, higher prices, but it's also going to mean damp demand.
What matters is the persistence of that shock.
This war continues to ramp up. That's where the risk will increase from shock to structural inflation.
We have to price in more of the energy cost pressure on the broader economy.
You do get concern that there is an inflation problem that becomes broader down the road.
That direction is higher inflation, probably higher rates.
It seems pretty attractive to invest in the bond market.
I think that bond markets are actually behaving pretty rationally right now.
Central banks are going to be as hawkish as possible without hiking.
If they end up hiking in the near term, they're going to be cutting pretty significantly following that because they're going to cause a recession.
There's nothing the Federal Reserve can do. They can hike or cut all they want. It's not going to open the Strait of Hormuz.
Sometimes the best thing to do is do nothing.
And that brings us to our charts, plural, of the week. First is the sharp move in short-term yields. On Monday of this week, the two-year yield briefly topped 4% and then reversed course when President Trump delayed his strike on Iran's energy infrastructure. In the following days, persistent concern of an inflation spike has pushed the yield higher and earlier today back above 4%. Now, so far this month, we're looking at around a 55 basis point move, if you round it up, in the two-year, and that is the largest increase since going all the way back to early 2023. And what that's led to is a pickup in bond volatility. The MOVE index is now at its highest since Trump's Liberation Day tariff announcement last April. And this month's move of 41.6 basis points puts us on track for the biggest monthly increase since the 2008 global financial crisis. Now, the Iran war and the energy shock sparking uncertainty across the global economy. Even so, BlackRock's global fixed income CIO, Rick Rieder, is renewing his call for a Fed rate cut.
I think the Fed needs to cut interest rates. Now, we have an energy shock and an inflation shock, so you're a bit more patient around it. I think the equilibrium funds rate is closer to 3%. I think you need to get there because I think the interest rate channel is very different than it used to be, meaning who is affected by these interest rates today? The capex that we're seeing, the big companies, the hyperscalers are spending, the interest rate tool is not really that influential on how they spend. Small businesses, young people, low income are really getting hurt by this interest rate.
Bloomberg International Economics and Policy Correspondent Mike McKee joins us now. So, Mike, what might complicate that, of course, is this pickup in inflation or inflation expectations that we're seeing.
That's what we're seeing throughout the markets, and we're seeing it on Wall Street now from the economics profession. The Bloomberg survey of economists today raised their forecast to 3.1% for PCE inflation in 2026. In their February forecast, it was 2.6%. Then we had the University of Michigan's one-year inflation forecast today. Consumers, they're looking at gasoline prices. They raised theirs to 3.8% from 3.4% 2 weeks ago. So a big rise in a very short period of time as people get used to the idea that prices are going to go up, particularly for energy. And that's being reflected in the chart I brought along today.
Please.
Which is, it picks up on what you were talking about with the two-year yield. And this is not just that the two-year yield has gone up, but this is that the two-year yield is trading well over the Fed funds effective rate right now, which tells you that markets are thinking that rates are more likely to go up than go down at this point. And then you've got inflation swaps. This is the CPI inflation swap in the blue there. And it has also started rising significantly. And that's more of a pure inflation play than the two-year note. There's not a term premium in that. But both of them show you that there is an expectation for inflation. And it started where that red line is. That is the end of February. And since March began, the whole move towards what the Fed is going to do, the whole thinking about what the Fed is going to do has changed. I don't know if you've seen the WIRP function lately, but if you look at the graph that they have, the bar chart that they have, at the end of February, all the bars were pointing down
because people were expecting
rate cuts, and now all the bars are pointing up. We haven't priced in a full rate cut yet, but the idea is that we're getting closer all the time.
All right, Mike is sticking with us because we're pleased to welcome Torsten Slok. He is Chief Economist at Apollo for this macro conversation. And Torsten, you heard what Mike was saying about inflation expectations, and we see that in some measures. What are you thinking about inflation expectations? Because there's market-based measures, there's also survey-based measures. It's not really time to worry until everything points in the same direction, right?
Well, and the key issue is that, of course, headline inflation is showing signs of higher inflation. That makes total sense because headline inflation also consists of food and, of course, importantly, energy. Core inflation expectations, we don't quite know yet what they are doing. But what we do know is that when you look at various other sentiment indicators, including today we got consumer confidence, also starting to go down. If you look at the daily indicators for consumer sentiment from Morning Consult, it's also going down for low income, middle income, and high income households. But the key issue at this point is that if you look at the actual spending, the daily data for how many people travel on airplanes is still good. The weekly data for Redbook same-store retail sales, meaning what was sales in stores last week relative to the same week a year ago, is actually also still very strong. And what you're also seeing, even hotel demand on a weekly basis from Star is also very strong. Both RevPAR is strong, the daily rate is strong, the occupancy rate is strong. So there's a very different divergence between what are consumers saying relative to what are they actually doing. So at this point, the duration of the shock has simply not been long enough to actually create that demand destruction that we all worry so much about.
Right. And in fact, if you look at longer term inflation expectations, and you see that within University of Michigan sentiment survey today, those are well anchored.
Absolutely. So both on a market basis and a survey basis, long-term inflation expectations are very, very stable and have not shown any signs of going up. In fact, some of them have actually started to go down. So exactly, the Fed would mainly worry about our markets getting worried about inflation becoming out of control. Maybe, yes, in the next year. We can call that transitory, temporary, whatever we're going to call it. But it's very clear the market is saying this is absolutely something that's only here for a very limited time. And then we will go back and have inflation expectations at the longer run, more stable level.
Now, the one difference here between the Wall Street folks and the Fed folks is perhaps the inflation indicators they're looking at. CPI has been going down, and it'll obviously on a headline basis go up. But PCE, even without oil, has been rising. And that's the index that they follow. When you listen to Fed folks, they're not talking about rate increases yet, but have they pretty much wiped out the idea of any rate cuts this year? Because the Bloomberg survey today showed economists think we're going to see a rise in inflation, but we're still going to see 2 cuts before the end of the year.
Absolutely. And what was also very interesting in the ECFC Go Bloomberg survey was that the probability of recession actually went up from 25% to 30%. So we're almost looking at more bifurcated distribution where either you worry a lot about inflation being higher and potentially above 3 now for a very extended period, meaning at least the next several quarters, or alternatively, people are beginning to worry about that maybe there is a harder landing that is also potentially an outcome. So that distribution tells you exactly what the problem is for the Fed, namely they worry on the one hand about inflation being high, but they also worry about if the labor market begins to deteriorate, including, of course, also if AI puts upward pressure on unemployment. And all those factors are, of course, the challenges for the Fed, namely how much should they put a weight on inflation relative to how much weight should they put on the risk that the labor market might begin to deteriorate over the next several months.
Well, let's stay with the labor market because the jobless claims numbers that we got this week ticked up slightly, but remain pretty much near historically low levels. Is the low hire, low fire market still intact and at this point not an immediate source of concern?
Absolutely. I think it was low hire, low fire because of the trade war for most of last year. And now I think it's low hire, low fire because of the energy shock. So that's why companies are responding in probably the most rational way by saying, we don't really know exactly how long time the shock will last. We don't know what oil prices will go to. So for that reason, it makes sense that the labor market continues to show this fairly cautious overall properties, especially, as you mentioned, Scarlett, that jobless claims continue to be relatively low.
What would we need to see in the jobs data, whether it's high frequency data or the monthly reports, to signal some kind of Fed relief is on the way?
Well, the key issue, of course, is next Friday, and particularly for fixed income more broadly, that is the most important number across the board, both for rates and for credit, namely, is the economy still producing jobs? Or, as we saw last month, are we still losing jobs the way that we did with the 92,000 decline that we saw in the previous month? And the key issue, therefore, becomes the labor market data is just taking a very, very prominent, more important role than usual, because inflation is telling us to hike. But now we suddenly have that the other side of the dual mandate, namely the labor market, might begin to show some more cooling, especially now that immigration restrictions and the labor supply is also weighing down on the overall outlook for non-farm payroll. So that's why next week is becoming very critical for thinking about what is the Fed going to do, because so far it's been easy for them in the SEP this week to just say, oh, we revised up inflation, and they also revised up GDP. But if the labor market begins to show softness, then that would, of course, become more challenging for them.
I have to ask you, when I was studying economics, they taught us a couple of rules. One was it's never different this time, and another was you can make a point forecast or a time forecast, but never the two at the same time. But in your chart this week, and this has gotten a lot of play in social media, you say we're going to have a very short-term disturbance in the bond market and 50 years of security in the Middle East that will keep down oil prices. That's quite a time forecast.
That's true. But I think the logic really here for investors is quite simple. We should all be stepping back and looking at this with a much more long-term perspective. Let's agree that the situation we have today, it's not sustainable. We cannot have this, we can discuss for how long time, but we cannot have this for several years, definitely not, and we cannot perhaps even have it for several months. And if that's the case, we should expect to have some resolution. It makes sense that it's complicated for everyone to figure out what is the military strategy, what's going to be response on both sides, but the conclusion must be that from a market perspective, we're getting closer to the midterm election in 8 months. From that perspective, there's probably also some political considerations, both in Iran and in the US, that comes to the conclusion.
50 years?
But I do think that at the end of this, we will probably have a situation that is quite different in the sense that we will probably have, at least from the GCC side in the Middle East, probably more connection with the US, probably more connection with Europe, and therefore probably also more stability more broadly relative to where we were just a few months ago.
All right. Well, I mean, we have to get through the fog of the current next few months in order to get to that point. You did bring along a chart with you this time that shows that there's a lot of supply coming to market, investment grade supply, a combined $14 trillion worth of supply. How did you get to $14 trillion?
Yeah, so the chart you look at here, it shows you from the Treasury, they put out data for what is the total amount of US Treasury debt that needs to be refinanced in the next 12 months. And as you can see in the yellow line, it is about $10 trillion that needs to be refinanced. In other words, US government debt that rolls over. So this is bills, this is coupons, this is across the whole curve. If you now add to that two other things, on top of that line, we also have $2 trillion in government budget deficit. So that brings us to 12 trillion. And finally, we also have about $2 trillion in net gross issuance from the hyperscalers and the banks in IG. So that means that the total supply of investment grade bonds that are coming to the market is about 12 trillion from the government and 2 trillion from corporates. That brings you to a number that is roughly, given US GDP is 30 trillion, roughly 50% of GDP that needs to be absorbed by financial markets. That's a the highest number we've seen in history. That's a very substantial amount of bonds of investment grade credit and investment grade bonds that are coming to the market. So the short answer is, if we already worry about inflation going up because of Mike's chart with inflation expectations going up, we have tariffs putting upward pressure, oil prices putting upward pressure, we have a fairly strong economy also putting upward pressure, and now we also have significant supply coming to the market. That does bring the risk that there is some upside pressure on rates, both in the front and the long end. And there's also on top of that, because of the significant increase in IG debt, also upward pressure on credit spreads. That means that both spreads and credit are under upward pressure for these technical reasons, and also the level of yields in rates is also under upward pressure because of the supply being so significant.
So very quickly, how are you thinking about the demand dynamics then? Because we already know what the supply is going to be. There's going to be a ton of it.
Well, that's why a lot of the people who spoke just before we started here discussing are exactly saying that this is actually an interesting time to look at the level of yields, especially if there is now an environment where oil prices might eventually come down, and especially if people begin to worry about that the economy might also begin to slow a bit down. If that's the case, you both have a level of base rates that's higher temporarily at the moment, but you also have spreads in credit that's also temporarily higher, and that does give an all-in yield in credit, both in investment grade, but also some parts of high yield that actually looks quite juicy. Software has its own problems, but the rest of the high yield market is actually generally also looking at yield levels that are at more interesting levels at the moment.
All right, Torsten Slok, thank you as always for coming in. Torsten Slok of Apollo, the chief economist at the firm, and of course our very own Michael McKee, our senior international economics and policy correspondent. Still ahead on Real Yield, a moment of interest. Banks led by JP Morgan sold almost $15 billion of risky debt this week to help fund the record leveraged buyout of EA, Electronic Arts, drawing in $40 billion of orders. We talk loans and private credit next. This is Real Yield. is Bloomberg Real Yield. I'm Scarlett Fu. A moment of interest now because this week Bloomberg spoke with Lloyd Blankfein. The former Goldman Sachs CEO warns there's a growing amount of unsold private assets on investor balance sheets.
If you haven't had a crisis, it means you haven't had a reckoning. You accumulate tinder on the floor of the forest, and eventually a spark will come. But the longer between intervals where there's a spark that sets it on fire, the more that accumulates. So at some point, there needs to be a forcing function or a reckoning that causes you to come to grips with what your balance sheet really is worth.
All right, so let's discuss loans and private credit with our Bloomberg Credit Reporter Roundtable, Aaron Weinman and Olivia Fishlow. We're going to get to private credit in a moment because that's just kind of its own beast. But Aaron, I want to start with you because Wall Street Bank started the week trying to sell some buyout debt. And we're talking about Electronic Arts in particular. And there was a lot of scrutiny on the first few trading days of this debt. Walk us through why it raised people's eyebrows.
Well, I think the first thing to mention there is there's a question as to whether or not the banks, led by JP Morgan, left some money on the table. They, I guess, to use industry parlance, gave investors a bit more juice, just because this is a really large deal, a deal the size we've never seen before, or at least not in my time of covering leverage credit. And in order to get investors comfortable by taking risk in a new name that they are not familiar with, and a name with size, right? We're talking almost $15 billion in bonds and loans. You need to give them some juice to get them on board. That's a short answer.
Why did the bankers rush it if they left money on the table? Because the price jumped immediately afterwards. Couldn't they have waited to get better pricing?
They could, but I think the overarching answer there is there's a war in the Middle East, right? And that is shaping the decision-making of all syndicate desks right now. The go or no-go decision is really important when you're looking to raise money in the capital markets. And right now, there is a lot of uncertainty and inconsistent messaging coming through from the administration in regards to next steps on the conflict. So therefore, when you wake up on a day when the president may or may not say that we're not going to perform any hostile acts today, the bond market will look at that and say, okay, let's get a deal done, because we don't know if tomorrow oil prices will spike again.
Right.
And so therefore you make a decision based on
You go with what you know. And what a lot of investors know right now is that they're not feeling great about the environment, Olivia. And we've heard that firms that offer private credit funds are being hit with these redemption requests. Some firms have given in and basically fulfilled all the redemption requests. Others have basically said, you know what, we're going to cap withdrawals.
Yeah, it's definitely an interesting time because this is the first time we've really seen investors start to want out of private credit. And so by that nature, every firm is responding differently. And like you said, some are choosing to cap redemptions and not let investors out, and others are getting pretty creative with how they're able to fill these redemption requests.
And it's also interesting because private credit used to be the domain of sophisticated institutional investors, but now more and more you have retail investors at least being targeted for a lot of these private credit funds. Are they the ones leading the redemption requests?
So it's definitely hard to say who's leading it, but these funds are targeting retail. At the same time, there is some idea that some of the institutions that maybe won out of these funds are able to get redemptions out in full. So it really depends, I guess, on who's trying to get out and how many.
Right, 5% being the kind of set level. And very quickly here, Olivia, JP Morgan is now deciding to launch a new private credit fund where they would allow investors to redeem 7.5% a quarter.
Yeah, so it looks like they're trying to do some new innovation in the market, and they're even asking for the ability to do monthly redemptions and give 2% every month. So they're still asking for permission on that, but definitely would be very interesting if approved.
All right, there's always a way to find opportunity when there's some stress in the market. Bloomberg Reporters Roundtable here on credit, Aaron Weinman and Olivia Fishlow. Thank you so much. Hope to see you again soon. Still ahead, we're going to go down to our credit roundtable and speak with Dominique Toublan. He is head of U.S. credit strategy at Barclays, and Winnie Cisar. She is global head of credit strategy at CreditSights. Much more coming up. This is Real Yield on Bloomberg.
Happy Friday, I'm Nora Melinda. Let's take a look at your midday movers. U.S. stocks are sliding this afternoon, with the tech-heavy NASDAQ 100 now in correction territory, down 10% from its October high. The S&P 500 and NASDAQ 100 are both on track to notch a fifth straight week of losses. their longest losing streak since 2022, as Wall Street continues to grapple with escalating tensions in the Middle East. Meanwhile, the Japanese yen weakening to 160 versus the dollar for the very first time since 2024. The impact is sending oil prices higher as investors price in growing supply risks with no U.S.-Iran ceasefire in sight. Traders bracing for the Iran war to stretch into April, with transit through the Strait of Hormuz still largely halted. And over in crypto, Bitcoin, Ethereum, and Solana are tumbling as investors pull back from risk, with geopolitical tensions around Iran driving a broader flight to safety. Bitcoin falling to its lowest level in more than 2 weeks, as traders turn to defensive following the year's largest options expiry. And finally, cybersecurity stocks are falling after a Fortune report said Anthropic is testing a new AI model that, quote, poses significant cybersecurity risks. CrowdStrike, Palo Alto Networks, and Cloudflare are among some of the names falling this afternoon. Those are your midday movers. I'm Nora Melinda.
Coming up next on Real Yield, the auction block this month making records with U.S. high-grade bond sales, the second largest March on record. And taking a look at what's happening across financial markets at the moment, you take a look at yields. On the short end, they are coming in. The two-year yield now below 4% after touching that level earlier, 3.92%. The 5-year at 4.07%. But yields at the long end are rising right now. The 10-year at 4.42%. The Consumer Sentiment Survey out of the University of Michigan showing a deterioration in confidence from consumers. Equities are also in the red as investors may be weary of being long heading into the weekend with the prospect of more surprise announcements from President Trump. The S&P 500 down about 1%. The Nasdaq 100, which entered a correction, a 10% decline from its recent high, it's down by 1.2%. And the Russell of small cap stocks losing ground by 1.1%. This is Real Yield. I'm Scarlett Fu, and this is Bloomberg Real Yield. It is time now for the auction block, where we highlight the big credit issuance of the week. And we start with U.S. high grade, where we saw around $27 billion sold from more than 20 issuers. Foreign firms led the way with names including Glencore, NatWest, and Enbridge. For March, despite all the market volatility, we are actually seeing the fourth busiest month on record. It's actually the busiest month on record outside pandemic times in 2020. And Bank of America and Citigroup have begun selling chunks of a $57.5 billion bridge loan backing Paramount's takeover of Warner Brothers Discovery. The two banks, along with Apollo, agreed to provide one of the biggest ever bridge financings for the buyout that was announced last month after a protracted bidding war. And speaking of credit, as we discussed earlier, there are still concerns around certain parts of the market. David Leibowitz from JP Morgan Asset Management discussed them on Bloomberg earlier this week.
We have concerns in the credit market, and those concerns in the credit market are directly tied to software and technology. And so, I think people are going to put push their spectacles up their nose, if you will, when they're looking at these investments going forward. And it's not going to be about buying the beta. It's going to be about understanding, as we go from adoption to implementation of a lot of these technologies, where those alpha opportunities actually exist.
All right, let's dig into all that and the themes of this week with our credit roundtable. Winnie Cisar is Global Head of Credit Strategy at CreditSights, and Dominique Toublan is Head of U.S. Credit Strategy at Barclays. And I feel like we have to start with private credit, given all the headlines this week. Investors are seeking redemptions. Firms are limiting or halting withdrawals. Dominic, has private credit turned into a bit of a roach motel? You can check in easily, but you can't really get out?
First, thanks for having me. Yes, private credit is at the center of many, many discussions out here from credit investors, but also from every investor around the world. So it's a good time to be a credit strategist, I guess. So our view on this is that there is stress, but it's not systemic. And the way we get to this conclusion, just very quickly, there's 4 risks we're looking at. What is the liquidity? What is the contagion risk? What is the risk in the structures? What is the credit risk? What is quite clear is private credit is quite exposed to the software sector.
Yep.
The AI disruption is putting some of these names into question. As the previous speaker just said, you need to re-underwrite quite a few of these names. But we think it's a slow burn rather than an immediate implosion here.
So, Winnie, let me come to you, because as for who is behind the redemption requests, it's not clear whether it's retail investors or maybe even some of the family offices that a lot of these firms are now targeting. I'm curious, how stable is the investor base for these private credit funds?
Yeah, I think this is a great question, and one that gets a little bit lost sometimes in the private credit discussion. As it is a very opaque asset class, there's been a lot of growth on the institutional side with pension funds, insurance companies being very tied up in private credit. And from a liability asset matching perspective, a lot of those funds make sense from an investment portfolio decision standpoint. Now, on the retail side of things, we do estimate that about less than 10% of private credit, really direct lending, is owned by retail investors. And while that's a very manageable number overall, you can see significant swings in how an asset class is viewed, how it's marked, and the type of liquidity provided to it when you have just a smaller proportion of investors that are trying to reassess and perhaps leave the asset class.
So, Dominique, at what point does this spill over into public credit and lead to a broader repricing across the public credit market, or even possibly contagion? I know you mentioned that contagion is not what you're expecting, but if it persists.
I think the first thing you want to look at is what Winnie pointed to, is the flows, right? Because you see directly from the BDCs what's going on, so you have an indication of what's happening. For investors who want to take out some money, the fact that gates have been pulled up maybe is not what they want, but from a systemic perspective, this actually slows things down. So it's hard to have a kind of run on the bank, if you want, because of that. And it gives some time. Also, if you look at BDCs, for instance, they do have some liquidity available. So when we calculate, given the gates and how much liquidity they have, they probably have 3 to 4 quarters, conservatively, of liquidity that's available. So that way, I don't see the contagion. The contagion, what happened is, if you look at risk assets, if a big sell-off in a risk asset class, the other asset classes will suffer. The last piece to think about is, if now I'm the CIO of some investment fund and I say, we have too much exposure to credit, to private credit, how do I reduce the risk? I sell what I can. So I might have to sell some broadly syndicated loans rather than the private credit, because that's what I can sell. That's how it could just snowball, if you want. Again, not what we expect.
I mean, what the redemption requests really highlight, Winnie, is that there is more evidence of a liquidity mismatch risk. And I wonder if this is a cautionary tale of what happens when there is a rapid move to democratize access to private assets.
Yeah, I think that anytime you kind of open a new asset class to a wider spectrum of investors, there's going to be some growing pains and some considerations that ultimately we look back on and we think, oh, we maybe could have done that better. Within private credit as well, you have a really interesting track record where it outperformed public markets quite handily, even during prior periods of stress. When I look back at 2022 and 2023, when the public markets were much more frozen amid inflation fears, spread interest rate hikes, private credit had a lot of liquidity. They were stepping in and providing capital to high yield and broadly syndicated loan issuers who needed to refinance near-term maturities. And I think that's one way that we need to consider the linkages between the public and private markets that's maybe less appreciated right now. If private credit is no longer kind of willing and able to help those high yield and loan issuers that need some near-term liquidity, especially in periods of market volatility, we have a new situation on our hand rather than just kind of the symbiotic love-thin universe really acting well together.
I know private credit, Dominic, is not monolithic, but at what point do you know whether private credit has entered a true downturn in the cycle rather than just a series of idiosyncratic events?
So I think just from a pure credit fundamental perspective, we'll start to see that in the BSL market, right? Because why are we talking about private credit after all? It's because 20 or so % of exposure is in the software sector. The BSL, the broadly syndicated loan market, is around 12% of exposure. So we're going to see problems there. If they are systemic, we're going to start to see them there. To Winnie's point, very important, refinancing needs. What we see is that the towers, the wall of refinancing that is there is not this year, is not next year, it's 2028. And that's very common for leveraged loan issuers. They tend to refinance well ahead of the maturity time, and we are in the same kind of situation now. They were able to refinance relatively easily last year, right? So it's not that we have, again, an urgent need of refinancing. Doesn't mean that some companies will not have that need. Some will, and there are going to be some winners and losers. But on the bulk, on average, it's not there in terms of pressing needs.
Winnie, I got to ask you about junk bonds as well, because junk bond funds are seeing outflows for a 7th straight week. Are we seeing a regime change take place here, a shift from benign credit conditions to something a little bit more defensive?
It does seem like that's the case. And really, this is something that I would say started in Q4 of last year on the back of the First Brands and Tricolor headlines, where people started to worry a bit about credit fundamentals again, especially for CCCs. If you look at CCC performance last year, massively underperformed the broader high yield market. And that continued shift away from being truly risk on despite elevated yields is getting amplified because of this recent return to higher borrowing costs around higher Treasury yields and somewhat wider spreads. And so I think that it's a much more difficult operating perspective for a lot of high yield investors right now who are trying to thread that needle between we'd like to add yield to portfolios and also we don't want to add too much credit risk to our portfolios.
Dominique, what do you think?
So I think there's a huge contrast between lower quality and higher quality. As you said, there's been outflows in the left finance side of the world. Institutional support has been there still. It's not that we are trading at very, very wide spreads. On the investment grade side, inflows have been quite amazing because we've had all the ingredients that usually lead to outflows, S&P down, Treasury yields up, vol up, and we continue to see inflows. And these inflows are not only in retail. All the foreign investors I talk to, in Asia in particular, they are buying a lot. So there is money to be invested. Investors I talk to have cash on the side to invest, and it continues to be the conundrum they're in. These yields are high and very attractive historically, as Torsten was saying earlier, for like on the 12 months forward returns. It's pretty good entry point here.
All right, yeah, investment grade spreads have actually tightened this week as well, to your point. Thank you both so much. Winnie Cisar is Global Head of Credit Strategy at CreditSights, and Dominique Toublan is Head of U.S. Credit Strategy at Barclays. And if you want more talk on credit, check out the Bloomberg Credit Edge weekly podcast hosted by James Crombie on the Bloomberg Terminal and wherever you get your podcasts. Let's shift gears now and go to global return. Barclays is scaling back its asset-backed lending to small borrowers. Bloomberg learning here that the decision was made after both Tricolor and Market Financial Solutions collapsed. For more on this, let's bring in William Shaw, who joins us now from London. So it sounds like Barclays is making a bit of a strategic shift here overall.
Yes, that's right. So Barclays is rethinking its approach to asset-backed lending. Essentially, like you say, it's pulling it back a bit from these smaller clients like MFS, like Tricolor Holdings. Instead, it wants to refocus its attention on the larger corporates where there's more money to be made, there's less risk. They have been pushing up prices on some deals to reflect the new risk, and they've been pulling out of other deals. Should say this is not a strategic change as such, and as I understand it, Barclays could rethink the situation at a future point if the risk profile changes.
Okay, just walk us through what happened with the collapse of MFS and the financial firms.
So Tricolor collapsed in around September. Last month, MFS followed suit and collapsed as well. Barclays CEO Venkat, as he is known, has said that both of these potentially reflect deep and sophisticated fraud. So the case has drawn heightened attention to non-bank entities, which traditionally get less regulatory supervision. It's also inevitably raised a number of questions about Barclays' own due diligence process for taking on and keeping clients.
Yeah, certainly. That's going to be something that people watch for, especially when bank earnings season begins as well. William, thank you so much. William Shaw joining us from London for our global returns. Now, still ahead, our Muni moments and how March Madness is shedding a light on college basketball and how all these different teams have money at their disposal as long as you're looking at their endowments. This is Bloomberg.
We're just about halfway through the trading day in New York. I'm Nora Melinda. Let's take a look at your midday movers. First up, U.S. stocks are sliding this afternoon with the tech-heavy NASDAQ 100 now in correction territory, down 10% from its October high. The S&P 500 and NASDAQ 100 are both on track to log a 5th straight week of losses, their longest losing streak since 2022, as Wall Street continues to grapple with escalating tensions in the Middle East. The impact is sending oil prices higher as investors price in growing supply risks with no U.S.-Iran ceasefire in sight. Traders bracing for the Iran war to stretch into April, with transit through the Strait of Hormuz still largely halted. In corporate news, Carnival shares are dropping after the company slashed its full-year profit outlook, with surging crude prices driving up fuel costs. The cruise operator says those expenses are set to weigh on profits, with fuel alone expected to cost about $610 million in the current quarter. And finally, Unity software shares are jumping for their best day since November, after reporting preliminary first quarter results. The boost coming from the strength in its AI-driven advertising unit, Vector. Those are your midday movers. I'm Nora Melinda.
It is time now for Muni Moment. It's been a rough month for municipal bonds, the weakest in more than 2 years. The municipal bond index is down sharply in March, and that's leading some borrowers to delay deals. Bloomberg's Shruti Singh covers munis, and she joins us live now from Chicago. And Shruti, I imagine this has to do with the overall uncertainty and the volatility caused by geopolitics.
Yeah, munis are generally considered kind of a safe haven, a staid market that doesn't react to daily headlines as some other markets might. But we've seen that in March, the volatility has certainly hit municipal bonds. And we've seen changes in the market in terms of how deals are being priced. And we've seen the AAA benchmark for 10-year maturities rise by about 60 basis points this month.
So can you give us some examples of how certain municipalities or certain issuers have changed what they had planned to do?
So this week, for example, I was tracking a deal by the state of Illinois, and for example, in one of the series that they were selling, they decided to downsize the deal from what was supposed to be a little bit over $1 billion to a little bit over $900 million. There's also changes that underwriters were reporting to me in pricing. Variability in pricing isn't necessarily a common feature in negotiated deals, for example, because the deals come to market. There's a lot of discussion, leading up to it, but we've been seeing some variability even leading up to through the end of the deal.
Got it. Shruti, thank you so much. Shruti Singh, our Muni bond reporter, joining us from Chicago. We're going to stick with Muni Moment because with March Madness now underway, school finances are taking center court. And it turns out the best college basketball teams in the nation all have something in common. Elizabeth Rembert's been reporting on this, and she joins us now. So what is the one thing that they have in common, Elizabeth?
Well, they're all housed at very powerful universities that have very deep pockets. And those deep pockets are getting even more important in this era of changes in college sports. It's more expensive to run successful athletic programs as departments have to absorb student athlete salaries. There's NIL deals. They're paying their coaches more. And they're stuck in this perpetual cycle of trying to recruit top talent since students can rove from school to school. That's a very expensive recruiting cycle. So it really helps to have an institution with these powerful financial resources.
So it sounds like the strong get stronger, and you see that reflected in the makeup of the Sweet 16, don't you?
Exactly, yeah. Almost all of the teams are coming from the Power 5 conferences. And in my story, running the data, we see that the vast majority of them have endowments of over $1 billion. The vast majority of them have very prime investment grade ratings. And again, the majority of them have very strong enrollment and have seen enrollment gains over the past decade, which helps to have, a healthy roster of students paying tuition and housing payments.
Do you ever see any exceptions kind of slip in, and how far do they get? I'm just wondering how universal this is.
Yeah, there is always, sports commentators look for that Cinderella story every year, that long shot team that rises through the bracket. And this year, some sports commentators are kind of crying out the death of the Cinderella story. They're saying that maybe Texas is the closest thing to the Cinderella story since it had an 11 seed. It had to work its way from the first 4. But Texas is one of the athletic departments with the deepest pockets in the country, and I found in their 2025 annual report that they took in $336 million. So that might show you just how important these resources are for these successful programs.
What about schools that are tied to religious institutions, religious schools, how are they positioned in all this?
Yeah, religious institutions generally have a tough recruiting environment, just speaking very broadly. Across the country, enrollment is going down because of a birth rate that started dropping around the Great Financial Crisis and hasn't recovered. The pool of potential high school graduates is just shrinking. And as more young people fall away from organized faith, it's harder for religious schools to appeal to that, even nicher population within a shrinking pool.
Yeah, St. John's being one of those Catholic schools that people pay a lot of attention to. All right, Elizabeth, great reporting. Thank you so much. Elizabeth Rembert is one of our Muni Bond reporters here in New York. Still ahead on the real yield, the final spread, the week ahead. Investors are shifting their focus to the labor market ahead of a U.S. payrolls report that Torsten Slok gave a shout out to, due next Friday. Plus, Fed Chair Jay Powell is set to speak on Monday. This is Bloomberg Real Yield. I'm Scarlett Fu, and this is Bloomberg Real Yield. It's time now for the final spread, the week ahead. Coming up on Monday, we've got Fed Chair Jay Powell speaking, and the U.S. Senate recess is scheduled to begin. Plus some data out of Europe. On Tuesday, Nike will be reporting earnings, and we also get U.S. consumer confidence from the Conference Board, along with Eurozone inflation. Plus earnings from McCormick. On Wednesday, U.S. retail sales comes out at 8:30 a.m., and there will be Fed speak from Dallas Fed President Lori Logan, along with U.S. jobless claims. On Friday, most global markets are closed due to Good Friday, but there is one big data point that is set to be released here in the U.S., and that is the U.S. jobs report. So for my final thought, traders are shifting their focus from war-driven inflation risks back to the labor market as a result, with the U.S. payrolls due out this Friday. And of course, we had to bring back Mike McKee to kind of walk us through this.
I'm one of the people that has to come in on Friday.
That's right, yes. Why are they reporting on Friday when it's a public holiday?
It's not a public holiday. It's a market holiday. It's a tradition that started at the New York Stock Exchange decades ago, but it's not a public holiday. So everybody in Washington is working.
Oh, I didn't know that. Okay, that's a distinction. Is the bond market trading then?
Bond market, I think, well, I'd have to double check, but usually they trade partially during the day because you got to react to the
one time that the stock market is closed and the bond market's open. Yep. Okay, potentially. Let's walk through what we're looking for from this jobs report, because the February numbers were not good.
February numbers were not good, and there's a feeling that that was kind of an outlier. So the estimate is at the moment 55,000 jobs created, 92,000 jobs were lost last time. And so at this point, that would be an improvement. The question is, are people going to be changing their views? Because we get a lot of data next week, including JOLTS, as you mentioned, and jobless claims, and the ISM numbers, and of course ADP. So we will have some hints as to where we are. But it's the jobless rate that really matters to the Fed, and it's not supposed to change. So I think we get out of next week without a lot of influence on what the Fed's going to do. The focus is still going to be on inflation, and everybody's going to be watching oil prices.
Right. I mean, when it comes to inflation and the labor market, there's always a lot of focus on the average hourly earnings. That is not top of mind right now because of what we've seen in oil prices.
Well, it's also because average hourly earnings have been slowly going down. They're rising, but at a slower pace. And the Fed has made it pretty clear they don't think that they're inflationary anymore. We're not seeing that thing where Scarlett has to go stand in line at the boss's office and say, I need more money because I got to pay more gas for gas.
Well, you don't know what my conversation was. Maybe I did do that. In any case, we also have JOLTS and jobless claims, so that'll kind of help set the tone here for that big jobs report. Mike McKee, thank you so much. Bloomberg's Michael McKee, our international economics and policy correspondent. That does it for us from Real Yield. Thank you so much for joining us. We will be off next week for the Good Friday holiday. Keep it right here on Bloomberg Television. Balance of Power is up next.